Everyone, good morning. Welcome back to the channel. So, we were discussing about the bonds, and we discussed last in the last episode. We discussed about the yields, the difference between yields of bonds. There is a coupon yield. There is a current yield. There is yield to maturity, and there is yield to call. So let's start our today's session. And let's move forward into this reading. My name is Deepak Visht, and we are discussing about bonds. Okay, so now let's discuss about bond duration and interest rate risk. I gave you a very little overview in the previous episode, and the when we talk about the duration and the interest rate, uh, that actually represents the risk. So, in simple words, duration measures how insensitive how the so duration actually measures how sensitive a bond's price is to its interest rate change, and in simple words, in much more simpler words, how much the bond's price will move when the interest rate changes. The key rule of duration is that the longer the maturity, the higher will be the duration, and longer coupon means also the duration is higher. And higher duration is actually that represents higher risk. So long term bonds are more sensitive to the rate changes. And think about it how. So if there is a bond which is the life of the bond is 3 years, and there is another bond which has a life of 20 years. So when we talk about the risk, so here when we talk about a 20-year bond, so here there is a chance of there is a more chance of change in interest rates. And here, because this is actually a smaller duration, so here relative to the 20-year bond, so the key word is here is relative to the 20-year bonds, relative to a bond whose duration is way too higher than this is called small duration bond. So relative to the other bond, relative to the that this bond, relative to this bond, the change in interest rate is low here. The change in interest, change in or the change in, let's say, sensitivity to interest rate, sensitivity to change in interest rate is low. Why I'm using relatively? Because when you are comparing things, so you cannot compare it in isolation. So you need something to compare with. So that's why relativity. If you look at the 3-year-old bond, you do not have any of the parameters to compare it with. So you cannot make any assumption whether or not the risk is high or the risk is low because you do not have anything to compare it with. So that's how you always need the data to compare across. So lower the smaller maturity means the risk of change in interest rate is low relative to that bond which actually have a high duration, longer maturity. When we talk about lower coupon rate, when the coupon rate is lower, this also represents higher duration, and we will discuss about this in detail in the next sessions. So if I try to explain it here, it will be very vague, and you will not be able to understand how coupon rate is lower uh, affects the higher duration. So the just try to understand the key rule here, that higher duration means higher risk. Now let's talk about what is actually a modified duration. So modified duration gives us, so when we modify the duration of a bond, and this also is very actually is something which is for advanced level folks. I have to put it in this presentation. Okay, so this will be helpful in the future readings. We will talk about when we will discuss about the fixed income securities, we will revisit this thing, this formula. So understand this thing. If the interest rate actually increases, the bond's price fall, and the duration tells us how much they fall. So percentage change in price is in a negative relation to the duration and the change in yield. So that's basically the formula for modified duration. We cannot I cannot explain this formula unless until I actually have to take you to the Excel, and we actually have to derive this formula using numbers. So then only I will be able to make a sense out of it. So as of now, just understand this formula. So percentage change in price is equal to the negative duration into the change in yield. Y represents yield. So the meaning here is that if the interest rate increases, if the interest rate increases, the price of the bond will fall, and the duration tells us how much they fall, because this is actually constant, and this is a change, and this is also a change. Okay. Now let's talk about the risk in bonds. So when we talk about the risk in bonds, so there is a credit risk. Credit risk means that the issuer may default and not pay. There are various credit agencies which rate those bonds. S&P, Fitch, Moody's are some of those. Interest rate risk is the risk which is related to increase in the rates. So bond prices fall when the rates rise, and we have established that thing in the previous episodes, because interest rate, we are actually discounting it, we're discounting them using interest rates, whether it's cash flow or whether it's the face value. So rate comes in the denominator, 1 plus rate. So that's why if the rate increases, the value decreases. If the rate decreases, the value increases. Bonds prices, not the value, but the prices. Inflation risk means the purchasing power erosion. So inflation actually reduces the purchasing power of the bond. So this is actually a kind of risk, because we are actually investing for a longer horizon, or a horizon more than 1 year at least. So within 1 year, there is going to be a considerable amount of inflation, and you actually have to uh, factor in factor these risks when you talk about the yield of the bond. Yield means return in simpler terms. There's liquidity risk also. So liquidity risk means that the liquidity risk means that the bond may be hard to sell. And here, let's assume that a company with a bad rating there is a company with a bad rating, and you bought that company's share, and now you are trying to sell that bond in the market. You bought the bond of that market. You bought a position in that bond. Now you want to sell that bond, and nobody in the market is willing to take it away from your hands. So that's the liquidity risk. Even though initially you were given a very good discount, but now the liquidity risk has arisen because there is always a liquidity risk with bad investments, or those investments which are uh, uh, those investments which nobody else think of as profitable. So that's liquidity risk. That's it's that means basically the whatsoever investment you have, that's very hard to sell. You are not able to find a buyer for that. Right. So after the liquidity risk, there is reinvestment risk. Reinvestment risk means the coupons may be reinvested at lower rates. We have not discussed about reinvestments, and so basically reinvestment risk. Okay, let's talk about reinvestment risk now. So reinvestment risk. Let me just erase so that I can make a timeline here to understand this thing. When we talk about reinvestment risk, we are basically talking about, so reinvestment is this, the risk is the in bonds is the risk that cash flows uh, you receive from a bond. uh, I mean, reinvestment risk in bonds is the risk that the cash flows you receive from the bond, or coupons, payments, or principal, when the bond mature, will have to be reinvested at lower rates, lower interest rate than the bond originally paid to you. So think about it, how it works. So you bought a bond. You bought a bond. Let's say you bought it for 5%, and over time you received periodic coupon payments. And if the market interest rate falls by 2%, and now you can only reinvest that money, that coupon rate at 2% or at 3% because 2% it has fallen down. So your overall return will end up lower than expected. To understand this thing, when we talk about this reinvestment risk, I'm saying initially you invested at 5%, and let's assume the coupon rate is 5% and the the face value is 100, just for simple calculation purposes. So they gave you 5 rupees here, $5 here. You have received the $5 or 5 rupees, but now you want to invest this 5 rupees at the rate of 5%. No, you cannot do that because the rates have actually fallen down to 3%. Now you actually have to reinvest that money at 3% here also. So since if once the interest rates fallen down, so you actually uh, have to reinvest that money at a lower interest rate, and it affects your actual realized return and not the bond's stated yield. To understand this thing, it's especially important for investors who depend on income like retirees. And it is one of the reasons why yield calculations assume reinvestment at the same rate, which may not happen in reality. In bonds, I mean, the bonds which are most exposed to reinvestment risk are callable bonds. Callable bonds, if you remember, I gave an example. If a company has initially raised debt at 10%, now because of interest rate fall, the company is able to issue that debt again at 8%. So what they will do is they will call all the uh, bonds from the market, and then they will reissue at a lower price. So reinvestment risk is so callable bonds are exposed to reinvestment risk. High coupon bonds are also exposed to reinvestment risk because more frequent and large cash flows are there to reinvest. So if you have high coupon bonds and the market interest rate falls down, so there is going to be a reinvestment risk for you. And when we talk about shorter term bonds, so there is also a reinvestment risk involved here because principal is returned sooner and it must be reinvested. And bonds with less reinvestment risk are zero coupon bonds, uh, long term, low coupon bonds, or low coupon bonds. To understand this thing, uh, initially in the previous topic in here only we discussed that higher duration means higher risk. Yes, but when we talk about the long duration, long term low coupon, long term but low coupon, long term but low coupon bonds, so they are overall they are less, there is a less reinvestment risk here. Even though the risk is high, but there is going to be lesser reinvestment rate for long term and lower coupon bonds. Zero coupon bonds are those bonds where there is no coupon payments throughout the tenure of the bond. And high coupon callable bonds and shorter term bonds, they actually have uh, the reinvestment risk because callable, because for obvious reasons, high coupon because of there is a large cash flow where you actually need once the interest rate fall in the market, you actually have to look for a better opportunity for your investors to reinvest it, and you cannot reinvest at a lower rate than your the portfolio of your fund, sorry, the performance of your portfolio, or your fund, that's going to fall down. And for shorter term bonds are actually sensitive to the market. They are actually the most sensitive to the reinvestment risk because market actually moves in cycles. Uh, Now, as of now, if you are aware or not, the market is actually moving towards an AI bubble, just like the dot com bubble uh, in previously. And now the market is moving towards an AI bubble, and it's all over the Wall Street. It's all over the news also. Uh, so think about it. The market actually moves in cycles, and recession, growth, peak, boom. So those are all parts of market, and you cannot do anything about it. But yes, you can uh, prepare yourself for those kind of conditions. So short-term bonds are actually, we were talking about short-term bonds. So short-term bonds are actually sensitive to those cycles. And y- so, so your bond actually matures right before the market starts to fall. So it's a good thing because the interest rates are going to be high. But your bond matured right before. when the in the short range when the market were at their peak. So the government is now going to cut down, slash down the interest rates so that the market mm, gets saturated. So at that time, there is going to be a considerable reinvestment risk. Okay, I hope reinvestment risk, we have talked about it in detail. Now let's talk about what uh, call call risk is. So call risk is again about calling of the securities, callable bonds. So the best scenario is that previously the company has raised equity at equity raised debt at 10%. Now because the market rates are slashed, so now they can raise debt at a cheaper price, and that's beneficial for the company also. Okay, I hope this is clear. So let's talk about bond structures and features. So bond structures and features, there are callable bonds, putable bonds, convertible features, bonds with convertible features. There are covenants, which is just again a fancy term for rules and regulations. There are positive covenants and negative covenants. Positive covenant means the borrower puts in a condition that the lender puts in the condition that the borrower actually has to fulfill. The borrower can do, and these are the do's and the don'ts. Simply, when we talk about, okay, just let me just give you an overview of what convertible feature is. So let's understand there is a bond. Uh, so you actually have a convertible bond. Let's say you have a convertible bond of $100. Let's say one bond. You actually have only one bond, and I'm saying that if the stock price goes above $20, you can convert this into shares, 5 shares. Now understand this thing. Until unless your bond satisfied that condition, you cannot convert it into equity, those 5 shares. Until then, let's assume there is a 10% coupon payment for you. You will be getting $10 every quarter, every year. But if the, so that's one thing. But if the stock price reaches $25 and you can have 5 stocks, so now understand this. So you are going to have 5 stocks. So you will have $125 worth of stocks. You can sell those stocks immediately in the market. You can convert your bond into you can convert it into 125 5 stocks, and you can book $125 for those 5 stocks. So initially, so you what you will actually have to let go. I mean, this will go away, but you will have an upside in the equity. And until unless then you will only be having $10 of coupon payment annually. Or else better if the stock price moves to $50. So then you will have way too much spread for you. You will have way too much profit. You will book the profit, and you will you will move out of this position, and you will find something better. If you have a better use of this money, you can do that. So if there is $50 worth of stocks, so it's to somewhat around double. So you can sell, uh, you can get one stock for $20, and okay, you can book, you can get 250 for $100. So the spread will be $150, immediate spread. So that's immediate profit. And now, if you think that you can use this thing, so this is the strategy. And here in convertible features, when you talk about convertible features, so these are features which are actually embedded in the bonds when the company is at risk or at the initial stages when the startups actually raise funding from borrowers, from investors. So let's talk about and let's try to complete this as soon quickly as possible. So bonds and but the other debt instruments. When we compare the bonds with with other debt instruments, for example, let's talk about bank loans. When we talk about bank loans, so bank bonds are actually tradable on in the market over the counter (OTC). No, they are exchange traded, and bank loans, no. Bank loans cannot be traded, bank loans. But yes, there is an instrument which is asset backed securities or securitization, which we will discuss. And you will see that we can also trade bank loans. But when we compare in the layman's, bonds can be traded, bank loans cannot be traded. Investor base is wide, bank loans has a limited in base. Pricing is market based, bank loan is contractual. Flexibility is high, yes, and bank loans are actually a lower flexibility. Bonds from investors perspective. Now let's talk about bonds from an investor perspective. Why do people buy bonds? And the reason is that there is a stable income, there is capital preservation, there is lower volatility than equity, there's diversification and liability matching, pension and insurance. Yeah. Pension and insurance. When we talk about pension and insurance funds, so the pension and insurance funds are majorly into fixed income securities. Bonds actually provide a peace of mind, not excitement, but equity does. So equity, investing into equity is for those peoples who actually love risk, love taking risk. All right. And when we talk about bonds from an issuer's perspective, one question comes into mind: why do companies issue bonds? And companies actually issue bond to access large capital so that people can invest into those companies. Companies can raise capital, lock in long-term rates. So if they are writing in contracts that at this rate, XYZ rate, the XYZ percent rate, so they can lock in long-term rates. There is no liquidity dilution unless until they are convertible securities, convertible features, unless until they have convertible features. And there is flexible structuring. So bonds allow funding without losing ownership. And finally, let's talk about why bonds are preferred because predictable cash flow, lower risk than equity, portfolio stability, and income generation. Portfolio strategy, step of portfolio stability. So, what does portfolio stability means? Uh, if you have securities, let's say you have XYZ, ABC, PQR, and you have bond one, you have bond two. The bond one, bond two, every month they are giving you $10, and as every quarter they are giving you $10 and $50 as your coupon payment. At times, these securities might reflect negative returns, but the bond is actually always going to give you these coupon payments, whatever be the market conditions, because this is debt and this is equity. And you know about this that interest payment, whatsoever be the circumstances, the companies do have to pay their debt holders the interest payment at least. So that's the main reason portfolio is stable when we talk about it, unless until. So this 60, if the loss from these Uh, if the loss from these equity securities is $60, if in they are still in the loss till $60, so this will actually set off everything, and you will be in a situation where there is no loss, no profit. But if the equities, the market is favorable in the market is favoring equities, and you are having $60 of equity, uh, so this means you will have $120 of profit at that time. So this is how actually it helps in diversification. Portfolio stability. Bonds, having bonds in your portfolio actually helps you with portfolio stability. Why bonds are not preferred? And there is one school of thoughts uh, where bonds are not preferred because bonds, yes, lower return than equity. There is inflation risk, interest rate sensitivity, credit downgrade risk also. And that's why bonds are not preferred. But bonds are preferred because of these situations, and so these are the pros and these are the cons. That's what that's what it is. So everybody's opinion does matter, and you actually have to look from everybody else's opinion also. You actually have to understand everyone why and do's and don'ts of everything. Okay. Okay, so let's move to this. Actually has been a big reading. Finally, I think we can wrap this up in within few minutes. So bond market and yield curves. So bond market and yield curve. What actually is a yield curve? So yield curve uh, actually shows interest rates and different maturities across different maturities. So those are actually inverted. If the yield curves are inverted curves, so that's a recessionary signal. So if the yield curves are inverted in nature, so that's a recessionary signal. This having this kind of yield curve is okay, but this kind of yield curve shows a recessionary. This is a recessionary signal. Okay. So the final few more points. Uh, when we talk about bonds in personal finance, so bonds are useful in retirement planning, income stability, risk balancing versus equity. We just discussed here, and capital protection. So you are going to get your face value at the end of the period. And bonds in corporate finance actually helps us with long-term funding, refinancing, capital structure optimization. If you are using VACC, you know that with the usage of debt, there is an optimization and optimization of capital structure and leverage management. It helps with also the taxes. So when we talk about bonds, it also helps us with taxes because these are debt securities. So finally, in the end, the bonds are the foundation of fixed income markets. They provide predictable cash flows and capital preservation, but they also expose the investors to interest rates, interest rate risk. There is credit risk, and there is inflation risk. But when we talk about equity, so equity is basically about growth. When we talk about equity, so is basically about growth only. And bonds are more about stability. So now think about it. That's why pension funds are heavily invested into pension and insurance funds are heavily invested into bonds because of the stability. Pension funds, insurance funds are into stability. Hedge funds are more into equities. All right, so let's wrap this up quickly. And this was the end of our series where we are talking about bonds. In the next episode, we will be talking about what we'll be talking about. We will be talking about an amortization schedule. So in the next episode, we will be discussing about the amortization. Uh, Amortization of loans, amortization of bonds, everything about amortization. And I think I actually also have an Excel prepared for the next session, next episode. All right, then, guys, thank you. Thank you for attending this lecture. And I will see you in next episode. Till then, thank you and keep learning, stay sharp. My name is Deepak Bish. Thank you.